Let's talk about an idea that might sound completely backward. It comes from the book The Psychology of Money, and it's this. What if massive, life-changing success is actually built on a huge pile of failure?
I mean, think about it. We're all taught to get things right? Avoid mistakes at all costs. But what if that's just completely the wrong way to think about building wealth or chasing big goals?
What if the real secret was actually being wrong, not just once or twice, but over and over and over again? It sounds kind of crazy, I know, but it's a powerful pattern you see absolutely everywhere once you start looking for it.
To really get what I mean, let's start with a story about one of the most famous and successful creators in history.
So, picture it, the mid-1930s. Walt Disney's studio has already produced over 400 cartoons. We think of Disney as this unstoppable empire, a total success story. And yeah, his studio was busy, productive, people loved his work. But behind the scenes, a very different story was playing out.
That's right. As popular as they were, those short cartoons were financial black holes. The company was constantly teetering on the edge of bankruptcy, struggling to pay the bills, even with hundreds of creations to its name. And then, Snow White and the Seven Dwarfs came along. In its first 6 months, it earned $8 million, an absolutely staggering amount of money for the time. This one single movie, just 83 minutes long, paid off all the studio's debts, funded a brand new state-of-the-art campus, and basically secured the future of the entire company. When you look at the business side of things, those 83 minutes were all that mattered.
So get this, Disney's whole future was saved by one massive outlier success. And this wasn't just a fluke, it's a perfect example of this really powerful idea called the long tail effect.
So what is the long tail? Well, it's the idea that in a lot of areas of life, but especially in business and finance, the results aren't spread out evenly. Instead, you get what are called tail events. These are rare, super high-impact moments that drive almost all of the results. This chart here shows it perfectly. See all those little tiny bars? Those represent hundreds of small losses or projects that just broke even. That's the long flat part of the tail. But then, look at that one towering bar way over on the end. That's the one enormous winner. And it's so big, it makes up for all those other failures and then some.
And this isn't just about cartoons, not by a long shot. This long tail dynamic, it's a fundamental rule you see in pretty much every corner of the financial world.
Just look at venture capital, for instance. You know, the people who invest in startups. Their entire business model is built on this long tail idea. They might make 50 investments. They go into it fully expecting half of them to just go to zero. They're not trying to be right every time. They're just hunting for that one, maybe two, absolute bonanzas that will pay for everything else.
You even see this in the public stock market. JP Morgan did this study on the Russell 3000 index, and they found that over a long period, a shocking 40% of all the stocks in the index had what they called a catastrophic loss. Basically, they collapsed and never recovered. So wait a minute, if nearly half the companies were duds, how did the index as a whole do so well? Because the entire market's gains were driven by just the top 7% of superstar companies. The massive wins from that tiny group completely overshadowed all those losses. And it gets even more concentrated than that. If you look inside those winning companies, you find the same tales. Amazon has tried hundreds of products, right? But its massive growth is really driven by two things: Amazon Web Services and Prime. For Apple, it's all about the iPhone. So how do the most brilliant people in business deal with this? Well, they don't just understand that this is how the math works. No, they actively embrace it. It's a core part of their strategy.
I love this. This was Jeff Bezos' response after the Amazon Fire Phone was a total disaster. He wasn't apologizing. He basically said big failures are the cost of admission for finding that next game-changing winner, that next tail event.
It's the same thing over at Netflix. The CEO, Reed Hastings, says he actually worries when they're not failing enough. He knows that if every show is just a moderate success, it means they aren't taking the huge creative swings they need to in order to find a truly culture-defining hit. And check this out. Even Warren Buffett, maybe the most famous investor of all time, lives in this world of tales. He's owned between 400 and 500 stocks in his life, but he's the first to admit that the vast majority of his money comes from just 10 of them. Take away those few home runs, and his legendary record would be, well, pretty average. And that's really the heart of it all. As the investor George Soros said, the game isn't about your batting average, it's about the size of your wins versus the size of your losses. You can literally be wrong half the time and still make an absolute fortune.
So what's the big takeaway here? How do we take this really powerful, kind of liberating mindset and apply it to our own lives, our careers, our investments? The crucial shift is to stop judging every single decision in isolation. Don't beat yourself up over the stock that went down or the project that didn't quite work out. Those are just the small, flat parts of the tale. Instead, judge your performance based on your entire portfolio of everything you're trying. It's okay to have a bunch of duds as long as you also have a few outstanding winners.
This idea really flips our whole concept of success on its head. It gives you permission to try things, to experiment, to fail, knowing that failure isn't the opposite of success. It's a critical part of the process. So the question I'll leave you with is this: what's the next calculated risk you're willing to take?